the realization is starting to sink in for a lot of folks that are having a hard time finding those sources of capital. Now, in a lot of cases, they aren't necessarily looking at capital the right way, because we tend to look at equity and debt almost interchangeably, in the sense that we're saying, okay, it's all capital. The question is, what's the cost of capital? Last fall, it was a $20 million deal. We raised it all equity, 100% equity, zero debt. Nothing says you have to borrow. Right?
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome, everybody, to today's Capital Raising Show. I'm your host, Tim Mai, and today I have an amazing guest on the line with us. I met him recently, and I asked him, how much money have you raised? He gave me a really big number. In his career, he has raised over $300 million. That's a lot of money. And last year, with all the craziness in the market, he raised over $35 million. And so, yeah. Victor Menasce. Yes, and Victor is the senior partner of White Street Capital, which specializes in new development across several U.S. states. Victor is also the host of the Real Estate Espresso podcast. Victor is the author of the book, Magnetic Capital, a topic that he has been practicing for much of his career. He lives in Ottawa, Canada with his wife. So, guys, let's give Victor a big welcome. Woohoo!
Well, great to be here. Thank you, Tim.
Yes, thank you. Victor, if you can, let's start out. You can share with everybody a little bit about yourself and your journey. How did you get into this syndication space?
Well, my path into this space was not the typical career path. I actually started my career as an electrical engineer, designing microprocessors. So that was where I started, initially in the telecom industry, and eventually migrated through different high-tech companies, both public and private companies. Ended up doing one IPO, 5 mergers and acquisitions. Wow. And filed a handful of patents and just worked on really cool projects. I've got chips in Cisco Wi-Fi access points, pachinko patchy slot machines in Japan with Sammy Sega and NVIDIA. I've got a chip in the Patriot missile. I've got chips in seat back displays on Airbus aircraft, and cellular base stations from Nokia and Siemens and Motorola. The list goes on and on. So super cool background, not necessarily the most relevant preparation for a career in real estate investing. But around 2009, I was traveling back and forth to Tokyo every 2 weeks. We were building a new cellular network in Japan, and literally traveling back and forth to Tokyo every 2 weeks. It was burning me out physically, emotionally, and everything else. And there was this little thing going on in the United States called the Great Financial Crisis. And I saw the opportunity to acquire real estate for a fraction of construction cost, and made the decision to pivot out of the world of tech into the world of real estate investing on a full-time basis. A hard left turn, and the rest, as they say, is history. Learned a lot, made a lot of mistakes, but fortunately it was an environment that was pretty forgiving of mistakes at that point. Right. And so it was able to wallpaper over those mistakes and survive and thrive and get to where I am today.
Right. And great timing too, right? 2009. Are you seeing some similarities, with when you first started versus what's going on now?
Similar, but different. The causes are different. They say history doesn't repeat itself, it rhymes. And there are definitely similarities. But there's some very distinct differences as well, which we can certainly talk about as we, go into it.
Right, definitely. So share with us your business model. Are you only doing new constructions, or?
We're overwhelmingly new development. We definitely do look at value add deals. In fact, it would be far easier to do value add deals than new development. And the problem with a lot of value add deals is that they end up being an auction. And the issue with that is whenever there's an auction, the winner almost always pays too much, right? Because there's multiple bidders. And even in today's environment, there's a lot of money sitting on the sidelines, a lot of dry powder waiting for distressed properties to hit the market. And so that will find a new equilibrium. People are still asking too much on the sales side, but so there's still a gap of somewhere between 10 and 30% price discovery between buyers and sellers. But eventually buyers and sellers will meet each other. And what I discovered in the world of development is that there's really no one competing. If there's a market that is short on supply and there's an excess of demand, there's no one competing for that idea of how to solve that problem. And I just love building new things. And so, we went through a period of almost 5 years with virtually no new construction, very little. So there was a lot of pent up demand, and saw the opportunity to create value that way. And it's just been a great journey.
That's great. And so like even in this market with the uncertainties and the interest rate, continue rising, you are still pretty bullish on new development?
I think you have to be selective. So we've paused a number of development projects because if you go back 2 years, that anyone underwriting a development project would have made an assumption about what permanent financing would look like once that project was leased up and stabilized.
Mm-hmm.
The assumption would have been that permanent financing probably would have started maybe with a 3 or a 4 in that first digit. And today, when you look at permanent financing, it's starting with a 6 or a 7. And those are vastly, vastly different.
Yep.
So you might have underwritten the project assuming a cash out refinance and, put a bunch of money in your pocket and return capital to investors and all of that. That's a beautiful thing. And then you look at today's numbers and say, oh my gosh, we're massively debt coverage limited. Not only will we not get a cash out refinance, we're going to have to write a massive check in order to get into permanent financing. Now you're facing a capital call or selling additional equity. But it's not a pretty story either way. We just didn't feel comfortable in allowing ourselves to get upside down in that way. So we paused a number of projects. Now, that doesn't mean that everything is broken. So yeah, we're pencils down on a few projects for sure. But there's multiple ways to create value. One of the things that we've been very active in over the last year, 18 months, is land development. Land development is a long time horizon. It spans economic cycles, and the time horizons are such that, okay, we might be going into an economic cycle right now. By the time that project is done over the next 10 to 15 years, we'll probably have 1 or 2 more economic downturns in the middle of there anyway. So you have to count on that. You have to be planning for an economic cycle. So then what's the value proposition? How are you going to create value? And the simplest way I think about that is just talking about the land use multiplier. If you think about the value of land, most places in the country, agricultural land, anywhere from 3 to 10,000 an acre, pretty much anywhere in the nation. Unless maybe if you're growing wheat on it, it's a little bit more, but it's in that 3 to 10,000 range. If that land is entitled for a residential subdivision, you're probably looking at a couple of 100,000 an acre. If it is in a dense urban environment and you can put a high-rise building on it, it could be several million per acre, but it's the same dirt. What is it that distinguishes it? Well, supply and demand is one, and number 2 is entitlement. What are you allowed to put on it? If it's a FEMA floodplain and you're never going to build anything on it, you're not going to sell that land for anything more than $2-3 grand an acre ever, because its value is very limited. You can't develop it. So we see the opportunity to take land. Look, there's 2 ways to make money in land, right? You can take raw land, carve it up, entitle it for development, or you can go into a dense urban environment where it's already been carved up into pieces that are too small to be useful, and you put it back together. So land assemblies. Those are really the 2 principal strategies. And so we're very active today. Right now, we have about 2,000 acres of land that we're currently in development on. We're actually submitting the master plan for a very large project in Colorado Springs today, this very day. So that's a way of creating a significant amount of value, irrespective of what's happening with interest rates and all of that. You fund those projects with equity, not with debt. Or if you use debt, you use it sparingly, and then you don't worry about interest rates quite so much.
Right. That's good. When you so prior to coming to real estate, you already have experience with raising money on the tech side. Is that correct?
Correct. Yeah. Yeah. And I can tell you from firsthand experience that it is way easier to raise money for a proven business model or even buy an existing business. Like it's way easier to raise 300 million to buy an existing business than to raise 5 million for just an idea that maybe someday the market will develop and you might make some money. I mean, it's way easier. So understanding what investors' appetite is and understanding risk tolerance and all of the various elements. When I moved from the world of tech into the world of real estate, I had to relearn the process of raising capital from scratch. And when I did, I discovered that, oh my gosh, it's almost exactly the same. And that was the impetus for me to write the book Magnetic Capital, was that discovery that when raising capital is easy, it feels almost effortless. It's because there's a certain set of principles that are at play. And when it gets difficult, it's because one or more of those principles are missing.
Gotcha. Can you give us an insight into some of these principles?
So there's really 5. So the first, I'll just list them and then we'll go into them each one by one. So number 1 is relationship. Number 2 is trust. Number 3 is results. What's your track record? Number 4, you've got to have a compelling opportunity. And then number 5, you've got to have alignment between the goals of the project and the goals for the money. And if you hit on all 5 of those, raising money is remarkably easy. So let's talk about each one of those and what they mean. So what is relationship? Would you part with hundreds of thousands or millions of your hard-earned life savings with someone that you had no relationship with? Like we just met on the internet. Definitely not, right? And so it really starts with genuine relationship. And I'm not talking about networking. Networking is almost the opposite. Networking is a very utilitarian thing. You go up to a networking event, you've seen those folks. They're trying to get as many business cards as they can. And maybe after they've connected with you, they're soliciting you immediately. That's not relationship. That's using people for a business purpose. And I don't know if we're not in a live audience, but we have a number of folks online here. Put up your hand if you want to be used. Like nobody wants to be used. I don't see many hands going up. So guess what? If someone has money, their guard is up already. They know that people want to develop a relationship with them for one reason only, and that's because they have money. So they don't want to be used any more than you or I do. So it really starts with genuine relationship, and you get different things from different relationships. You might get advice. You might get introductions. You might get a friendship. Oh my gosh. You might get access to opportunity. You might get capital. You get all of these different things. You might get credibility. There's all these different elements that come from relationship, but it starts with genuine relationship. And maybe if it evolves from there and maybe somewhere down the road you do business together, cool. And if not, that's fine too. And you approach it from that perspective. Number 2, the second one is trust. And this isn't just, are you dealing with an honest person? It's a much deeper psychological contract with a lot of layers to it. You know, can I trust you to put together a good plan? Can I trust you to hire the right team? Can I trust you to execute the plan? Can I trust you to communicate in an open and transparent way? Can I trust you with my money? And on and on and on and on. And if any one of those are missing, it starts to chip away at the trust. So it's a matter of really understanding that multi-layered psychological contract. And I'm going to recommend a book for the folks that are on the line here today. And that is a book by the son of Stephen Covey. You probably heard of Stephen Covey.
Yep.
the author of 7 Habits, who sadly is no longer with us. But his son, Stephen M. R. Covey, wrote a book called The Speed of Trust. And sometimes it's misfiled. Instead of being in the business section, it's in the self-help section along with his dad's books. But The Speed of Trust. And there's a clue in the name of the book that when trust exists, decisions happen quickly.
Mm.
And when someone says, I don't know, we need a few more weeks to do our due diligence, it might be indicative that maybe some of the trust is absent. Now, that doesn't mean, if you're dealing with an institutional investor, they have a process to work through. They're not going to skip steps. I get it. But when trust exists, decisions happen quickly. They absolutely happen quickly. So that's trust. Number 3, results. Show me your track record. Show me that you know how to be successful. Show me that how you dealt when things got difficult. Show me how you handle things when it looked like you were going to lose investors' money, and so on. What's your track record? And that's important because, and it's an element of trust to it, but it's really showing what have you done? Because when lenders come to me and they look at me and they say, okay, Victor, for example, we're doing a project right here up in my hometown in Ottawa, Canada, and most of the work I've done in the States. So against that yardstick, they discount all of that. They say, well, Victor, what have you built here in Ottawa? And I kind of honestly have to say very little. We're talking about building a multi-hundred unit mid-rise apartment building, concrete structure in a dense urban environment, and I don't have a track record. So what do? I went and found a partner who has built 35 out of the 37 tallest towers in my own city, and brought him in as a partner. Nothing says it has to be all about me ever. So this is a team sport. So you might be thinking, I don't have a track record. How am I going to raise money if I don't have a track record? Well, then go work with someone who has that track record and borrow from their credibility. Nothing wrong with that. So that's results. And by the way, I do that consistently. We have other partners in the States, and one of my partners has built 10,000 units so far in his career. So when they ask about, who has experience with HUD construction loans, I push Bob to the front and say, well, meet my partner, Bob. He's done 15 of these deals. It's never about me. So that's number 3. And then number 4 is you got to have a compelling opportunity. And this is where most people start. I've got a deal. Everyone wants a deal. I got a deal. And it's never really about the deal. So that's part of the reason why I put it 4th and not 1st. So what is a compelling opportunity? Well, it's a little bit in the eye of the beholder. For some people, it might be a medical office building at 90% occupancy and an 8% cap rate. That might be their definition of beauty. Is this image on the magazine cover beautiful? Well, maybe. It's in the eye of the beholder. For someone else, it might be, I don't know, 100,000 square foot industrial building at a 7% cap rate or whatever. Mm-hmm. So it really comes down to that. What is compelling for you might be different for someone else. And then the last one is alignment. And this is where you've got to match the goals for the money with the goals for the project. And I think of it like a pair of shoes. You could have the most beautiful pair of shoes and they're on sale and, it's your lucky day, but if they don't fit, you're not a buyer. It doesn't matter how beautiful they are or how deeply discounted they are. So what is the fit? The fit is, what's the size of the investment? What's the term of the investment? What's the rate of return? What's the risk? What's the security? What's the tax consequence? What's the control structure? And on and on. There's about a dozen of these different criteria. And what you'll find is the more sophisticated investors are very precise on exactly what their investment criteria are. And it's the unsophisticated investors that are rather unclear. But when you're dealing with sophisticated investors, you want to make sure that you have that perfect fit, that perfect alignment. Because if you don't, it's not going to work. You're going to waste a lot of your time and a lot of theirs trying to court investors for whom this will never, ever fit. Because it almost fits, but it doesn't quite fit.
Right. What about going all the way back before relationship happens? How do you market yourself? How do you even begin to attract the passive investors into your world to build a relationship with?
It starts with positioning. So let's talk about what. So let's talk about what is marketing first. Okay, so
Mhm.
marketing is the process of generating interest, and there's different types of marketing out there. In my world, I'm not a fan of interruption marketing. Those are the folks that call you during the dinner hour to try and sell you on duct cleaning and things like that. That's interruption. That doesn't work. And even now, wherever you're sitting right now, I can virtually guarantee that you're being bombarded with advertising that
Mhm.
you completely don't see. You tune it out. It might be, I don't know, your the logo on your laptop computer, or it might be a logo on a coffee mug. I mean, everywhere around you, I can guarantee there's at least a dozen ads right in front of you right now that you can't even see.
Mm.
So you don't want to be trying to interrupt people. What does work in today's environment is educational marketing. People are willing to be educated. So what do? I run a podcast, the Real Estate Espresso podcast. It's a daily show 7 days a week. I think, if I'm not mistaken, today was episode 1907.
Holy cow.
And we have a very, very loyal listener audience. And what do? We educate. That's it. It's nothing fancy. It's simply providing one piece of quality content every day, and that starts a dialogue with investors or with a listening audience. And the subset of those may become investors at some point down the road. And
Right.
it's about positioning. And I say this with all humility. We don't even go hunting for deals. They all come to us. And it's simply about being positioned in the marketplace, making sure that we are accessible, that people can find us. And the way we show up, whether it's at a live event, online, in an event like this, wherever it might be, we show up consistently. And when I say that, I don't mean consistently as in on time, although that's important too, but with a consistent image. We're not confusing people. Sometimes people carry a business card that might have, ABC Capital on the front, and then they've got a Hotmail email address. That's inconsistent. So you want to make sure that you are packaging yourself properly so that you are consistent. People will believe that you're actually in business for real, and that there's demonstrable evidence, that trail of breadcrumbs, that you're doing good work. Those are my thoughts.
As you mentioned, having your podcast is a pretty big part of your positioning and marketing. And then you also are interviewed on other podcasts. Have you found one to be better than the other, or what are some of the pros and cons of having your own podcast versus, getting yourself on as many of other people's podcasts as possible?
When you're a guest on someone else's show, you have one opportunity in a short window in time to connect with the audience, and it's a very fleeting connection.
Mm.
And if there's, a week later, another guest, and 3 weeks later, 4 weeks later, you're now forgotten. So it's very difficult to develop a relationship by being a guest on other people's shows if you are not already warm within that audience. You experience the same thing going to live conferences. You can go to a live conference and you meet someone for the first time, but you go to the same conference 4 or 5, 6, 10 times, and you meet the same people at the same conference each and every time. You develop a relationship, and you're not going to do business the first time you meet, but you might on the 6th or the 10th. So there's something about the process of relationship building that requires repetition and showing up consistently, so that people start to develop that relationship and that trust. So
Mm.
I think you can build a name for yourself by being a guest, but I think you either need to be a repeat guest, or I actually am a big believer in complementing the online and the offline worlds together, so that when you show up at live events, people walk up to you, and this happens to me regularly. People walk up to me and say, "Hey, Victor, I've been listening to you for years. I'm so glad to meet you." And I have
Mm,
no idea who they are, but they feel like they know me really well. It's a very
right.
surreal experience.
Yeah, for sure. On your podcast, do you do interview style or do you generate your own, you teach your own content?
So because it's a daily show 7 days a week, when I launched the show, I was looking for something that would be differentiated in the marketplace. Just doing another show that was once a week, a 45-minute interview, asked myself the very hard question, why does the world need another show like that? It doesn't. I mean, the average listener who subscribes to podcasts probably subscribes to 6 and listens to 5, because that's all they have time for. So if they're going to listen to me, who am I going to kick out? Am I
Mm,
going to kick out Joe Fairless or the real estate guys that are in their 26th year? Am I going to kick out Oprah? Like, I mean, seriously, who am I going to kick out? So I had, be realistic about that. So could I design a show that would compete without competing? And what I came up with was, well, guess what? People don't have a lot of time. So what if it was a daily show, and like your shot of espresso, we're not talking about
mm,
know, the big gulp. We're talking about the little morning shot here. This is literally 5 minutes every day on the weekday. So the weekday
I
edition
see.
is just me. And then the weekend edition are interviews with notable people from the world of investing. And those interviews are 12 to 15 minutes. And we mix up the content. Some days it's listener questions. And the first of each month, there's a book of the month book review and things like that. So it always feels fresh. And a lot of the topics are tie-ins to the news. So if the Federal Reserve makes an interest rate announcement, you're going to hear about it the next morning, not 3 weeks from now, because it's not relevant any longer.
That's good. I like that a lot. So besides podcasting, what else is there anything, podcasting and speaking, obviously, anything else that you do in terms of marketing to attract new investors?
Those are the principal ones. It's a lot of relationship building, working with notable people, brokers, accountants, folks that have relationships that can make introductions. And when you develop a relationship with those connectors, then they say, they say to their network, you should really connect with Victor. He's got something interesting going on that I think would be potentially a good fit for you. And a lot of those introductions happen that way.
Right. Okay. So once someone, heard you speak or get on your podcast, what is your funnel to take them from a prospect like that all the way through to an investor that invests in one of your deals?
Sure. So there's really a multi-step process here. We use a customer relationship management system. We use actually Pipedrive, and their name goes into that. And we literally track all of those dialogues with that potential investor. If they come into a pipeline that might be, let's say, for example, I don't know, Norris Ranch, which is a large land development project that we're working on, then they would show up in the Norris Ranch pipeline, but they would also appear in our contact database. If they We'll get on a almost a know your customer type discovery call with a member of our team, just to understand what their objectives are. Are they an accredited investor? Or, what are their goals? And from there, we may offer, if it's a fit, we may offer to them, would you like to be added to our investor portal? That way you'll have an opportunity to see the projects that are live and available for investment. No pressure. We really take the perspective of it's got to be a fit. If it doesn't fit naturally, if there's any element of it that feels forced, we don't want your money. Plain and simple, because it's not going to work. We know that. So we don't want to waste our time. We don't want to waste yours. But if it's a fit and our goals are aligned, it could be a great partnership. So that's the perspective. And everyone gets their own login, and they get to see, all of the due diligence data room for the project and so on. And then there's an opportunity for them to ask questions, and If they want to invest, they click a button and they say, okay, I'd like to put 50,000 into this project. And then that kicks off a whole series of things, get your accredited investor letter and all of the rest. And, we go from there. But it's a
Gotcha.
team effort, and there's a lot of systems and automation that goes into that so that nothing gets lost. And if they're talking to somebody new in the team for the first time at a different step in the process, they don't have to re-educate that individual on everything about them, because that's all contained in the CRM, and that person will review it before they get on a call with them, and they can now enter that conversation fully up to speed, as if they had been part of the dialogue all along.
Right. That's good. What about things like newsletters? Do you do emails, newsletters? Do you do physical newsletters or anything like that?
We have not done that, and for a deliberate reason. And then, by the way, we are talking about potentially doing a newsletter, but because the reason is quite simple. Nobody woke up this morning and said, "Oh my gosh, I wish I was on another newsletter this morning." Like, just nobody does that. It's not filling a void that anyone has. So that's why we don't do it, quite frankly. So we don't want to annoy people. Now, we recognize that we're missing an opportunity to talk to our audience, and we are trying to figure out, if we do something along the lines of a newsletter, what would that look like? What would be a not annoying way of communicating with prospective investors that would actually add value to them? So we're still thinking that one through. But right now we're saying, nobody woke up this morning saying, I need another newsletter.
Gotcha. Yeah, it's great to hear your perspective. Like you look at things very strategically, right? You don't just do something because others are doing it. You're actually asking, does this serve the people I'm reaching out to? That's good. I like that. In terms of raising money for today's market right now, what are the challenges that you are seeing, both from your own deals as well as other investors? Yeah.
I think number one is that there's a large percentage of folks that are uncomfortable with the uncertainty, and in the presence of uncertainty, the alternative, the default is to do nothing. So there's a lot of folks that are saying, well, and even just as simple as, you might have had a project that was yielding, and I don't know, I'm just going to make up a number here. Let's say it was yielding 8% on a cash on cash basis, and maybe an IRR in the mid to high teens. But let's say that investor's objective is cash flow more so than appreciation. They might say, well, okay, you were offering me 7%, but I can get 5% in T-bills.
Yep.
That's not enough of a delta to compensate me for the development risk. It's too small of a delta. I'll be fine just parking it in T-bills and not having to think about it. Now, never mind the fact that 5% is still probably a negative real interest rate. So you're losing ground. But even if you put that aside, that is part of the mentality. And the other part is, well, if we are indeed headed into a downturn and there's going to be better pricing in 6 months, maybe I'll wait. Because if I invest now, maybe I'm not getting a bargain, I'm catching a falling knife, and that might be painful. So maybe better to wait if we are indeed in a down market. So those are probably the two principal sentiments that we're running into when it comes to objections. Now, are we still raising capital? Absolutely. Absolutely. I mean, we are, when we get into a dialogue with investors who understand what we're doing in our projects and say, look, this has nothing to do with interest rates. This is spanning economic cycles. This is, they get it, and they say, and they'll pull the trigger. But in a lot of cases, investors fewer of them are active in the market. There's quite a number that put pencils down for a period of time.
Right. What about the avatar type? So let's start with, who are your primary avatar? And then I'd like to also go into like what's the avatar type that are more open to investing in this market, versus the others. So yeah.
There's different investment objectives. So, for example, there's the high net worth individual or the ultra high net worth individual who has built a business, maybe sold the business. They're sitting on a pile of cash. They are first and foremost concerned about protecting what they have and growing it modestly, as opposed to necessarily the highest rate of return. Those are different objectives than someone who might be in their 30s, maybe a high income earner. They might be a high earning investor. They might even be an accredited investor on the income test, meaning they make more than 300,000 a year as a couple or 200,000 a year as an individual. And so they qualify as an accredited investor, but they haven't necessarily built a lot of assets. So their balance sheet might not be strong, but their income side is real strong. Those two individuals are vastly different in terms of what their investment objectives are. One is interested in growing. The other one is interested in protecting. And so the types of investments they'll make are different. It's a matter of understanding what their goals and objectives are. And again, back to that alignment piece. If it's an ultra high net worth individual, a lot of these folks have, a minimum. They won't invest less than 5 or 10 million. If you're looking to raise 200 grand, it's not going to work. It's not worth the paperwork to them. Now, some of you are probably saying, well, gee, I wish I had that problem, but it is a problem because their scarce resource is time. It's not money. So it's a matter of just understanding, what their goals are.
Right.
So you asked, who's the avatar? For us, it's the business owner who's sold a business, who's sitting on a lot of cash. They want it invested in a safe, tax efficient manner. Tax efficient is important. So they want us to do cost segregation and, depreciation expense and bonus depreciation if possible, and all of those sorts of things in order to protect the investment and get it done in a tax efficient way.
That's awesome. And then what's between those two, I guess, any particular ones that are more open to investing in this market and not waiting this out? I mean, is it necessarily that way? Okay.
No, it's not necessarily that way. It's really just understanding on a case-by-case basis. Everyone's different. And some say, yes, I believe that there are unmet needs in the marketplace that still need to be fulfilled. And it's more important to me to put the money to work rather than having it sit depreciating in the bank account, rather than sitting on the sidelines waiting for the perfect market bottom, timing the market bottom. Some people like to time the market. Others would rather dollar cost average. They say, okay, I'm going to do one deal a quarter. And yes, maybe I'll get a better deal 6 months from now. But I know that if I'm a collector of real estate and I just keep buying and I keep buying and I keep buying over time, time will heal those wounds and it'll be fine.
Right. Okay. Gotcha. In terms of attracting more of the business owner type, do you have, any strategies around that, or even the type of message to use to attract their attention?
Well, think about it from the perspective of, if you're a specialist in any one particular area, you have certain things that you think about. I mean, imagine for a moment, I'll give you another avatar. Think about a doctor. Doctors have a very specific language that they speak. They like to talk to other doctors because they believe the doctors understand them. They don't want to have to educate you or me about what their problems are. They want to talk generally to other doctors. So you often see doctors investing together. For whatever reason, it's because they understand each other. So if you can get into a dialogue with an individual in a way that demonstrates to them that you get them, that you understand them, and they don't have to waste a ton of energy educating you, then you have, I think, the opportunity to get into a meaningful dialogue. So I really think it starts with that. It starts with understanding the other side first. and demonstrating that you understand them in order to enter into some kind of meaningful dialogue.
Gotcha. Okay. Thank you for that. Yes. And what are some of the tools that you use in your business that help you with lead nurturing and lead capturing and all of that good stuff?
We use principally Pipedrive. That's probably the number one. We've done a lot of automation. We use tools like Zapier and things like that to integrate Pipedrive with our other systems, whether it's our Slack channels and all of the various other tools that we use in-house. So I would say that's probably the principal one. But at the end of the day, having a name in a database doesn't help you if you don't do anything with it. So then the question is, you've probably heard the term or the phrase, the fortune's in the follow-up.
Yep.
And it is. It's in that personal touch. It's in having dialogue with investors. We added in the last month probably 300 people to our Pipedrive, and we haven't gone into dialogue necessarily with every single one of them, but we've certainly had outreach to quite a few, and many are appreciative. They say, "Wow, you actually connected with me. How refreshing!" And it's not in a form of solicitation, because people get approached all the time, but there's something about the approach. If you do it the right way, people don't feel like you're after them. It's funny. I don't know how to put it into words, but you just got to have that right, je ne sais quoi way of doing things that doesn't cause people to feel like you're soliciting them.
Right. Yep. I want to circle back to the beginning of the call when you talk about the similarities and the differences in this market versus the market that you got into, the real estate space back in 2009. Can you give us some insights into that?
Probably the biggest similarity is the lack of liquidity in the market. Capital markets are absolutely tightening up for different reasons, but there is going to be a whole lot less debt available and at much higher rates. So it's not even a question of what's the interest rate? Is it available at all? Can I even get this thing refinanced? I think is probably a big question. And think about it from the perspective, I'll just give you a couple of things that point very clearly to this. Be interested almost to do a poll. I don't know if you can do that here in Zoom, but are folks dealing with the major banks for their real estate deals like Bank of America and Wells Fargo, or are they dealing with a regional bank? I'm going to bet overwhelmingly they're dealing with a regional bank.
Yep.
Now, we've experienced massive capital outflows from regional banks to the major banks. I think the number, and I could be wrong, it changes, of course, every day. Over the last couple of weeks, I think 129 billion moved from regional banks to the four largest banks. Well, if you believe that fractional reserve lending, let's say, if 129 billion equals almost 1.3 trillion in lending capacity, well, that's 1.3 trillion in lending capacity that's vanished from those mid-tier banks. That's now in the hands of the major banks, the big guys that are too big to fail. But they're not going to lend those same products to those same borrowers. So that lending capacity is vanished. It's gone, probably forever. And so that's a big deal. That's a big deal. We talk about the Federal Reserve doing quantitative tightening. They don't need to do quantitative tightening. This is more quantitative tightening than the Fed's done all year.
Wow.
So I think that's the biggest thing. As lending is going to be much more difficult.
I thought lending was difficult in 2009. I mean,
it was very difficult.
So is that not the same? I mean, if you have lending was difficult back then and lending is difficult now, is that not the same?
Well, it is, but it's for different reasons. It's right. It's for different reasons. So, there's going to be more private capital. Of course, lending is going to be expensive. They're going to want to see more covering equity. Just all the ratios are going to be skewed towards the lender because the lenders took a big haircut back in 2009, 2010. and 11 and 12. And they don't want to go back there again. And yeah, you can argue, okay, the Fed's got your back, but that only gets you so far. So as we've seen, if you're the CEO of a small bank, if there is even a modest loss of confidence, you're 48 hours from being in the unemployment line. You're out of a job. Your bank is gone. Didn't even take a vote of the shareholders. The regulator took it from you.
Wow.
Yeah.
Okay. Interesting. So where's the opportunity? What do you see as the opportunity in the market, considering, lending is going to be tightening up?
I think there's opportunity to buy distressed assets we're starting to see them a little bit now. It's a little trickle. I think it's going to become I don't know if it'll be a flood, but it'll be more than a trickle. I think we're seeing more and more of it. I'm starting to get phone calls from investors saying, I'm looking for capital and that has these characteristics. Where should I look? And I say, ouch, good luck. The realization is starting to sink in for a lot of folks that are having a hard time finding those sources of capital. Now, in a lot of cases, they aren't necessarily looking at capital the right way, because we tend to look at equity and debt almost interchangeably, in the sense that we're saying, okay, it's all capital. What the question is, what's the cost of capital? You could put an interest rate against the cost of equity. You're not pricing it that way, but you could, your blended cost of capital, say, okay, it might be a tiny bit more expensive to raise equity. Like we did a land deal last fall. It was a $20 million deal. We raised it all equity, 100% equity, zero debt. Nothing says you have to borrow. Right.
That's good. Very good. For the folks that's on the line, wanting to learn more from you, connect with you, partner with you, invest with you, where would you like to send them?
Probably the best place. Well, first of all, love to have you as a listener to the Real Estate Espresso podcast. It's on pretty much wherever you listen to podcasts, 120 different platforms. You'll find us. So that's a daily show, 7 days a week. If you want to reach out to me directly, my email address is victor@victorjm.com. And happy to connect with you that way. Our development firm, Y Street Capital, apart from doing development projects on our own, we do have a small consulting division. We don't put a shingle out there advertising it and things like that, but we do have a handful of clients from around North America that reach out to us and say, okay, I've got 40 acres. What can I do with it? And so we have a handful of clients that we work with across the United States and Canada on those types of consulting projects. So we're, I think, pretty good at land development at this point, in entitlements and underwriting and all of those sorts of things. So
very cool. Do you do anything in Texas?
Oh yeah.
Okay.
Yeah, absolutely.
Very cool. All right, awesome. All right, Victor, thank you so much for doing this interview with me today. I really appreciate you. You've been a wealth amount of knowledge. And yeah, we'll transition to our Q&A now. So thank you so much, Victor, for this part.
My pleasure.